All right, I'm going to spend a few minutes on this video going over John Deere's most recent quarter because it illustrates a very important concept about cyclical and industrial companies that have relatively high fixed cost structures. And Deere just gave us a really good example of what can happen to profitability when you have an upside surprise in revenues. Often you can get an explosive upside surprise, much larger upside surprise in profits. So we're going to actually walk through their most recent quarter, look at their income statement, and we're going to see how it played out, okay? So in the description below this video, I'm going to have a link to their press release. And if you want to pause the video, open that link, and then go to page 13 where they have the consolidated income statement, okay? And if you look, you can see that in the quarter last year, the year-over-year quarter, they printed $9.2 billion in revenues. This year's quarter, they printed $12 billion in revenues. So that's about a 30% growth rate year over year in revenues. It's very, very good. But what's super striking is when you look at the net income line, and you can see last year they printed $666 million in profits. This quarter, they printed $1.79 billion in profits. So the revenues are up about 30%, but profits almost tripled. So you had like a 280% increase in profits on a 30% increase in revenues. So that's the central insight. You get a massive move in profits when you run just a moderate amount of incremental revenues through a business with a relatively fixed cost structure. And so this is what happens with cyclical companies or industrial companies, especially the really good ones, when they're managed well, when times improve. So you want to keep that in mind, and this is why people want to own these companies at certain times of the economic cycle or at certain times when things are improving for the given company's industry, okay? Now, the final point I want to make is about the stock itself. And it's actually kind of striking because the other day when they printed this quarter, the stock reaction was actually kind of blah. It was only up like 1%, something like that. And why would that be? Well, if you look at a one-year chart of this company, you could see that the stock has already moved. It's up massively over the past year, most likely in anticipation of these really good results and of this phenomena of disproportionate profitability. So the whole idea here is you have to make the investment in anticipation of these good results. And it's kind of almost an act of faith. When times are tough, and it's an objectively very good company. Deere is a very, very good company. You just have to hold your nose and maybe buy the stock, put on some of the investment, and just wait. And then what happens is the stock moves in anticipation of these really good results. So, is it time to buy the stock now? I don't know, but probably not, right? The money's probably already been made with Deere, and that's probably why the stock didn't really move that much when this quarter print happened. So these are two really important ideas that are often counterintuitive to beginner and intermediate investors, and it's important that you get them just to have a deeper understanding of how these types of companies work. Okay? So thanks for watching, and I'll talk to you soon.